business or are you running a business? Valuation is the ultimate KPI.
Hey there, it's Mike Langford. Welcome to another episode of the Modern Financial Advisor Podcast, brought to you by Truelytics, the one and only comprehensive advisor transition management platform. This week on the show, I have Jeff Conyer, the CEO of Wealth Advisor Financing, with me for an in-depth discussion about, well, financing options for RIAs and independent financial advisory businesses. This is a high-impact episode with loads of great insights from one of the newest members of the Truelytics Solutions Partner community. The list is growing, and it's fantastic to see all of these innovative providers join together to help independent financial advisors and RIAs achieve their goals. Before we get to the conversation with Jeff, I have some huge news. Truelytics has agreed to be acquired by Envestnet. Yup, that Envestnet. You can read all about the deal on the Truelytics blog and across the financial press, to be sure. But here's the high-level gist. This is going to mean an even more powerful solution for you, whether you're an independent financial advisor or a RIA firm or a large broker-dealer, because the firepower of Envestnet and all of the intelligence and data they have piped into the Truelytics solution, this is going to be amazing. Awesome stuff. So huge congratulations to the team. I really look forward to seeing what the future brings with Truelytics powered by Envestnet. Okay. Lastly, please do make sure you subscribe to the podcast on your favorite podcast platform. You can find the show on Apple Podcasts, Spotify, Stitcher, SoundCloud, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or a guest, please hit us up, podcast@truelytics.com, or ping us on the socials. We're everywhere. LinkedIn, Twitter, Facebook, you name it. And of course, YouTube's. Love to hear from you, okay? All right, let's get to the conversation with Jeff Conyer. Well, Jeff Conyer, so wonderful to see you. Welcome to the Modern Financial Advisor Podcast.
Thank you. It's nice to be here.
It is fantastic to be here. You know, it's the old saying, right? It's better here than nowhere, right? Like it's better than the
You're
alternative,
exactly
right?
You're right.
And for those Star Wars nerds who might be listening, we are recording this on May 4th. So May the 4th be with you. A little bit late because this is, we're recording this and publishing it a week or two later, but May the 4th be with you, of course. So fantastic stuff. I'm really looking forward to this conversation, Jeff, because number one, you just partnered with Truelytics, and you and I had some great conversations prior to this recording. And I learned a lot of things that I frankly didn't know about the lending for wealth advisory firms prior to this conversation. And I've actually had the great pleasure of talking to a few CEOs at other lenders. So I wanted to dive in there. And, as I was mentioning, like I kind of like matured as a podcast host. I used to always ask people, hey, let's go, tell me about your history. How did you get here type of thing. Tell me a little bit about your career type of deal. And I've moved away from that because it just kind of felt a little bit lazy, frankly. And people just go to LinkedIn, they can check you out, what your experience is like. But I think this really matters here. Why did you decide to focus on advisor financing versus any other lending that you could have done?
Well, I've done a lot of other lending, so I think the advisor lending is really a progression in lending than it is falling into it. It's the course of 30 years of lending through the real estate market, through the commercial industry, getting to the point where I was a lifetime banker, had worked for big banks most of my career. And during that process, I was able to gain my Series 7 and 66 FINRA licensing. I didn't practice as an advisor, but it took the dedication of going through the process and the training and the daily work that you had to do, understanding what the financial advisors are going through to get qualified, and then the responsibility that they have as an advisor and working for banks or independently. So it was such a tremendous learning experience. And as life goes, you never know what your path is going to take you down, right? So, a lifetime lender with the background that I had and able to do business enterprise lending through the course of my life, then when I got the call that, there was capital needs for financial advisors, it was a perfect fit to do that.
That's fantastic. So what is it about this industry that you think warrants kind of a firm like yours exclusively focusing on wealth management, right? It seems like if I'm going to start a lending firm, like, well, maybe I lend to all different types of businesses, and maybe wealth management is one of them. But you've decided in the name of the company is right, wealth advisor financing. So you've decided to focus exclusively there. What made you decide like this is going to be our exclusive focus? It deserves that type of attention.
Well, I think it's a difficult enough industry that you need to specialize in it. I don't think that you can be efficient. I don't think you can structure credit efficiently enough to be good at this or be great at this without doing it every day. And I think if I was an advisor, I would want someone that's committed to the business every day, that's in it with them, that understands how their business works, that is dedicated and compensated on the success of getting them a loan. And, I think the commitment, 100% commitment into the industry shows that, first of all, I have faith in them and this industry. I feel like it's going to be expanding, not contracting from a financial standpoint. So I think the need is going to be there continually. And, when you find something that's kind of niche in the banking industry or financial industry, and you can understand it and be good at it and be efficient at it, I think the industry needs you in it as much as you need the industry. So that's really what my calling was when I started hearing about it and seeing it kind of fit into place for what I do and what I have done. So it's a little bit of fortunate opportunity there, and and the business being vibrant and ever changing and consolidating, all of those things are good for the financial industry.
That's awesome. It's really interesting. You mentioned something kind of just in passing there that I think is worth shining a light on, right? Just for this space. So, your solution, lending for financial advisors and wealth management firms. You mentioned that it's a growth opportunity, right? And there's going to be more demand for it. And part of that is the portion of the cycle that we're in for the wealth management industry, right? Many advisors are the first generation of advisors, if you will, are starting to phase out. They're starting to retire out of the business, right? The average age of a financial advisor today is 60, 62. You hear that number frequently. Many of those people got their start when they were stockbrokers and they're kind of, maturing out of the business. And so the next wave is coming. So that's a catalyst for growth for your business. But the other thing is there's so much room for growth in this industry, right? I mean, I did a show not too long ago in prep. I just looked at some data, and it showed a recent study showed that like only 1% of Americans use a financial advisor. It's like, that's a huge amount of growth available, right? Like very few Americans are working with a financial advisor. Many of them have financial accounts, but they don't have like a dedicated advisor. It's like, so the room for growth here is massive. So I think you've picked a really exciting vertical.
Yeah, I agree with you. Definitely it's not only are the advisors getting older, the senior advisors getting older, and it's getting more difficult to be in the space. I mean, the requirements of the advisor, the compliance pieces of the advisor, the back office support that's needed, really the size that you need to be efficient as an advisory firm, really lends itself to not being a mom and pop shop anymore. You really have to manage this as a business. You have to work at this as a business. You have to manage your financials as a business. And all of that stuff starts to get complicated when you try to do it on your own, where you're the back office support and you're the rainmaker for the firm. So I feel like all of those things are causing not only consolidation, but people to consider retirement as well.
Yeah.
And to kind of ride off in the sunset in some instances, not necessarily sell outright right now, but you see a lot of partial acquisitions and succession strategies to exit the business.
Well, and that's just really good business, right? I mean, you shouldn't just like decide one day you're yanking the plug, right? You should, like, in an ideal world, you do. You're right. You have some form of planned path for exit, and whether that means you start working with fewer clients, maybe your select clients, and have a junior advisor taking over some of your other book, or bringing in, selling part of the business to another advisory firm, and then that allows you to kind of, right off into the sunset, as you said.
Yeah. And you have an attachment to your clients as well.
Yeah.
I mean, you've served those clients for so many years. They become your, part of your friendship group, your family group, whatever. Their kids. You may be advising their children. So you want to hand your firm off as you would any other business you've grown. You really want it to succeed after you're done. So I think all of that plays in the succession strategy very much. And, it's important to us from the financial end to understand how that transition is going to happen and how efficiently it'll be.
Yeah.
And how many of the clients you'll retain and what the revenue will be ongoing, and all of those things that go along with, handing off and selling a firm.
Right. It's interesting. You talked about how it's getting a little more difficult for the, solo advisor to operate, just because, there's a level of complexity, right, to the industry. Some things are getting better, right? Technology is getting a little more efficient and so forth. But, it's interesting. This industry, similar to the lending industry, has a history of just like hiring people in large numbers, right? I have a little bit of a recurring joke that I've used on the show, which is like, the industry will hire anybody who can fog or mirror, right? You want to be a financial advisor? Come be a financial advisor. Come on in. We'll put you in a training program. You know what you do? You bring your address book, whether it's on your phone or wherever, and you'll start calling everybody come in and so forth, and we'll turn you into a financial advisor, right? And it's a numbers game. A lot of them wash out, but the strong survive, right? The people who are really good with people skills, really good at sales, they survive and they become financial advisors. And the ones who get really good at managing complex relationships, they start to get the big clients, right? The high net worth and the ultra high net worth clients. I imagine some of that same stuff is true for the lending industry, right? You and I were talking about in prep, like, what makes you special in order to do this. And you mentioned that it requires a lot more skill, right, and expertise to be able to do this type of lending. What is the type of skill and expertise that is required to do this type of lending versus, I don't know, being a mortgage broker?
Well, I think the first thing is you have to understand that we're lending on a revenue stream and not on a building or on a car or on, merchandise or inventory.
Yeah.
We're lending on the probability that the revenue that you've made will continue and grow, and that you have a strategy or a plan for maintaining, dealing with the ups and downs in the industry. So we really want to understand what your firm has done and use that as a measurement of what we feel like your firm will do moving forward. So historical performance through difficult times, through recessions, through pandemics, through, changes in the market, the rockiness of the stock market in general, understanding how you've performed during those times is the historic measurement that we're looking for to understand the probability of how you're perform moving forward. So I think that's a difficult thing for some to understand and some to deal with and to grasp, that a revenue stream is an adequate collateral for how expensive wealth advisor firms are getting now when you're buying them. So I think that's a couple of points. There are many others, but those are a couple of points that I think are critical.
Well, and that is so interesting. And I think it's worth spending, a little bit of time on, shining a light on, is that, as a financial advisor or wealth management firm, you don't have assets in the classic sense of the word. You don't have a factory. You usually don't have any intellectual property, like patents or anything like that, right? That you don't have a building that you own usually, even, right? So there's no assets to serve as collateral for what we consider traditional commercial loans. And so there is some nuance to lend on just a cash flow basis of like to your point, we have to have confidence that this cash flow will continue and be robust enough to service the debt that you're taking out, right? And so historically, I don't think many banks have been willing to do that because they just didn't have the knowledge of understanding like how robust is this cash flow?
Yeah, or how do I collateralize it as a bank? It's not a normal footprint for us. So typically when it's not normal and it's not part of the normal collateral structure that you're used to lending on, then everything else is an outlier. So is it a big enough volume of revenue for regional banks and national banks to get in this product when we have to create a whole package that deals with wealth advisory products? So I think that piece is difficult and maybe not worth the lift for them at some point. So, I think it fits well into the more localized lending structure where, you can gain enough volume to make it worth your while as a bank. And I think that's where you'll see the success in the industry if you can find the experience to structure it and place it properly. So I think those are critical pieces.
Yeah. I want to spend a little bit of time talking about kind of some of the, process-oriented stuff, because I think for many advisors who may be listening to the show and firm owners, this is something new. I would suspect the majority of financial advisors have never thought about borrowing money to conduct an M&A transaction, or that there is money going to be available for the buyer of their business, right? Somebody who might want to acquire their business might be available, or any other reason why they may want to borrow money for the business. So I want to dive in a little bit. One of the things that you mentioned in our prep call that really jumped out to me, because I'd never thought about this before, is that it gets a much more complex on the M&A side when we're dealing with a multi-partner or multi-owner firm, right? So a lot of firms, it is a solo advisor that owns the firm, and he's got either a junior advisor and an assistant or whatever. But quite frequently, these firms get bigger, and there's multi-advisors under one roof, and they all have some sort of ownership process. So let's dive in there. What are some of the complexities that come into play when you're dealing with these multi-partner firms?
Well, I think the biggest complexity and the difficulty that I think most would have is you have a number of financials that you have to spread to understand what the global cash flow is that allows us to determine what loan amounts can be, what the maximum lending potential is for the firm. So it's not unusual to see individual tax returns, corporate tax returns, operating company tax returns, financial statements for all of those. In some cases, all of the individuals are taking individual companies as well, and there'll be tax returns associated with individual expenses that are not shared in the corporation. So it can get overwhelming to balance all of that data and to be able to compile all of the data and to be able to demonstrate that data for an underwriting group, I think is a complex piece of the structure, and one you need to be good at keeping your ducks in a row and understanding what you're looking at, efficient in looking at tax returns, asking the right questions, and then just making sure that you can get the document lift done, which is really the difficult part up front, is saying, hey, I'm going to need some tax returns from you. It's not going to be comfortable, but hopefully I'll be your partner for many years, and this will be the difficult lift. And from this point on, I'll be your advocate for keeping this up to date and making sure we can do it on an ongoing basis.
That's interesting. You mentioned the discomfort, and it is true. One of the co-founders of Truelytics, Terry Mullen, used to talk about how when he would speak in front of an audience of financial advisors, when we were talking about doing a valuation for the firm or whatever, he would ask, like, how many of you have a P&L for your firm? And Very few hands would go up in the audience because most advisory firms are not doing like that type of, regular income statements and balance sheets and so forth. And then he's like, you actually would be surprised at how many would go, what's a P&L?
Yeah.
Look, this isn't a dump on financial advisors. Here's the thing, and this is not throwing shade. This is just the reality. I kind of mentioned it at the beginning of the show. Like many advisors got their start when they were stockbrokers. That joke of we'll hire anybody who can fog a mirror is not really a joke. It's actually kind of what happens, right? So many of these advisors didn't study finance. Many of them probably weren't even business majors in college, right? They responded to a call to come effectively be a salesperson, and they worked their way up and they became very successful. They own a business, and over time they have learned some advisory skills and they've added some new things to their tool belt, but they never set out to be business owners. In fact, one of our recent guests on the show, Robert Russo from it's Independent Advisor Alliance. I said before I had said Individual Investment Advisor Alliance, Independent Advisor Alliance. He said many advisors are accidental business owners. And like, that's 100% true. And it's a great way of saying it. So to your point of like, they're not prepared for the heavy lift of documents that are going to come their way for securing a business loan. I don't think that's out of turn to say that.
No, it's not. And it's not that they're not good business owners. It's that the business ends up expanding. And then to say, I have an idea of what I'm making and what my costs are is a real statement. I think most all advisors understand what they're making and what they're spending. What I don't think they understand is at some point you're going to have to demonstrate that for someone. When you have to demonstrate it, then it's not, I have a good idea of what it is. It's show me what it is.
Yeah.
Show me on your tax return. Show me what you did at the end of the year. It's going to take several months when the year ends before you're going to have your taxes done. What did you do at the end of the year? What have you done since that end of the year as far as revenue and expenses? And those are the pieces that I think are not considered. And I think the other piece is I think it's understated how much value it is to actually run your business like a business, look at your P&L and understand where you can gain, where you're losing, where you may be able to make some changes maybe and be more profitable, be more efficient. But I think operating like a business and running a P&L and balance sheet is a prudent practice, in my opinion.
And it's one of those things, it does take some time and effort. And so you totally understand. Like if I'm an advisor and I'm 40 years old and I'm making, I'll call it $400,000 a year, got a great client roster, the money just comes in, right? Every quarter I do my billing, I get paid, life is good, right? And I have a general idea of like how things are going, as you mentioned. So you to some extent never feel the need, or it's probably rare to feel the need that I've got to dial this in like a business owner, but you may find, as an example, you're woefully underspending on technology, whereas some of your peers are spending a lot more on technology and investing there, and they're setting themselves up to be future-proof compared to you. Or there's a lot of, or maybe you're spending too much on technology. You find out, are you kidding me? Like I could save some money here and put more money to the bottom line. So to your point, there's more than just preparing yourself for borrowing money. There's some value in understanding the numbers. We always talk about on the show, benchmark yourself against others in your peer group, others who have the similar AUM, and get an understanding of how things are going.
Yeah, I absolutely agree. For sure.
One of the other things you talked about, and that I think anyone who pays attention to this industry has noticed, is that things have been getting, let's just say, a little frothy in the last few years as it comes to valuations and the acquisition of these businesses. Now, part of that is because money has been very cheap, and actually, of the day that we're recording this, the Fed just increased rates half a percentage, 50 basis points. So here we go. Money is getting less cheap. We've also seen private equity coming into the space and starting to acquire a whole bunch of different firms and kind of roll them up and so forth. So we've seen valuations go up and up and up. But one of the things that you mentioned in prep was that that's great for sellers from a pricing perspective. It's awesome. Who doesn't want to sell their business for more money? But it does make some deals less financeable, I think is a term you used. Let's dive in a little bit there because I think it's really important for advisors and owners of firms to understand the structure of these deals. How much can they borrow in relation to the revenue that's being produced by the business and then the cash flow that's being produced by the business? And where are some of the limits that we're seeing? So what makes a deal hard to finance?
A deal that's hard to finance is one where your revenue stream is limited in comparison to what you're trying to acquire. So if you're trying to take a big bite off the apple and buy a firm that's 3 or 4 times your size from a revenue perspective, you need to understand that your embedded equity is your revenue stream. So if you look at your revenue stream and say, I have $250,000 of revenue and I'm buying $1 million of revenue in an acquisition, you have basically a 75% loan to value on that revenue stream because, it's 75% of the overall value of the revenue that you have, or some in that similar sense. So I think that the difficulty is you need to understand that there are going to be loan to value requirements associated with the lender. And if you're doing multiples that are getting into the 4, 5, and 6 range, which we've seen some of, you just need to make sure that your embedded revenue is sufficient to meet the equity requirement for the deal. So I think every lender out there, definitely I would encourage you to call your lender, make sure that just kind of on the back of the napkin that some quick numbers can be done, and you can make sure that the revenue you're buying and the revenue you have can be supported in the deal that you're making. I think it's very frustrating for a buyer and a seller to come to a conclusion on buying a practice and find out that the deal is not financeable in the structure they've made.
Yeah.
So then you got to go back to the table. You got to go back and negotiate, and that can get tense. It can get tense for the deal. It can get tense for the seller. So I think understanding the rough numbers, understanding what you have the capacity to do from a lending perspective up front will help you in your negotiation with the seller and understanding what's possible.
So you bring up a good point. I mean, that, or at least it makes me think of a good point, maybe, or maybe it's a bad point, but I think it's a good point, is, kind of get pre-approved ahead of time, right? Like start talking to you before they go out and negotiate terms in a price for a deal, right? Like it's one thing to say, hey, I might want to buy your business. Well, let me go run some numbers here, versus just making an offer and getting things in writing. Like find out, are you going to be able to borrow the money? Like, would I be able to go out and acquire that other business that's, maybe going to be selling for, as you mentioned, 4 times revenue? It's like, well, okay, what's that look like, when the deal is done, and how much can I finance, and would I be able to support that debt? Right.
Yeah. I think when you start looking at your revenue and you're considering that you're buying a firm that may be 2 or 3 or 4 times your revenue, I think that should be a trigger to say, maybe I should talk to the bank or lender or finance company, someone that's experienced in this field, and say, do I have the capacity to buy this on paper?
Yeah.
I understand that I may not be the winning bid, but I want to make sure that when I negotiate this deal, that it's a deal that I can get funded. And I think, that 5 or 10 minute conversation will be very, very valuable for you when you start thinking about the pain that it causes to go back to the table and try to renegotiate something, especially when you're renegotiating, that number is always coming down. It's never going up. So it's going to be a bad conversation. Yeah. So it's one you don't want to have. You want to negotiate to the number that you can qualify for.
It's interesting. I was just thinking, are there warning signs that one could see ahead of time that would, I guess, prepare them for, hey, we may be off in the pricing, or I may want to come in at a lower price, as an example, or I may get less funding. One that pops to my mind is, the age of the client roster, right? So we just talked about earlier that the average age of a financial advisor is around 60 right now. And we know that the average age of a financial advisor's clients is somewhere in the neighborhood of 5 years around their age. So, if you've got an advisor who's 70 and you're going to buy their business from them, you're probably buying a client roster that's around 70. That's a client roster that's going to have a declining asset base, one would assume, over time. They're going to start to consume those assets. And so therefore the revenue is not going to be growing. It's probably, at least going to stay stable, but potentially decline. Are there other types of warning signs like that? Like things to think about when you're entering an M&A process for, hey, be careful of this?
Yeah, I think just communication with the buyer, understanding how deep they've gone in their conversation and analysis, their due diligence on the book. Are there opportunities within the book to grow the revenue stream? Sometimes, there are financial advisors that are coasting at some point when you get to a certain age, and I think that's well deserved and well earned, but there may be opportunities within the book to gain additional revenue. So that's going to be one point that you can look at that would be a very positive for growing the revenue stream. But certainly we would depend on third party valuation in understanding their view of the book, due diligence, like I said, from the seller's part, and then looking at what multiple of revenue are we dealing with, and is there any outside compensation that the owner is looking for in addition to the payment on the book? So are you wanting to stay on as to help with transition? If you stay on to help with transition, is there additional compensation being paid to you? Is the revenue sharing that we have to delete from your ability to cover debt? There's a lot of things in there that could be structured that could be, I don't want to say it's catastrophic to the loan, but it's stuff that, drives down your ability to meet coverage. And that's where we start getting concerned when we're talking about covering payments globally. We want to see comfort there, and we want to see probably additional coverage for sure, but comfort in that additional coverage after tax.
That makes so much sense. I mean, there's nothing worse than, all of a sudden realizing, hey, I'm going to have a hard time making this payment, right? In any scenario in life, but particularly in your business. And I think, what my advice from this perspective would be, hey, look, we're probably going to be coming out soon. At some point in time, the markets will pull back and go flat for a while, like they always do. We've had one of the longest bull markets we've seen in history. This year hasn't been the best, but things don't go up forever, right? Eventually you have some down market, and many advisors, we actually had a Kieran Bowl on the show from McKinsey not too long ago. And he was talking about how 75% of advisor growth, AUM growth, has come from market performance over the last decade or so. Yeah. That means, only 25% is coming from new clients and new AUM coming in. And so it's important to think about that in your business, right? Are you actually a growing business? Or has it just been like, hey, I've got free money, the market's gone up. Awesome. Yeah. And because there's two types of businesses, right? I mean, anybody can grow a business if all I have to do is have clients and maintain the relationships, and I do nothing else, and the market's going to carry me up, right? Anybody can do that. It's kind of like that fog or mirror type thing. Can you bring on new clients? Can you expand the client relationships that you have and bring on new assets and increase share of wallet and things like that? That's the real trick. And that makes you kind of impervious to down markets.
Yeah, I think you see that in your conversations with advisors. I think everyone loses clients every year, and people gain new clients each year. Some clients are those that they want to lose. I mean that are. Yeah, sure. I don't mean that to be a negative thing. I mean it that it's there. You get to a count, I think, as an advisor, and it gets difficult to manage that count. And it's always better to have, $1 million account than it is to have $100,000 accounts. Right. So I think the advisors that are growing AUM, understand how to do that. They're working hard towards that. They have a staff, they have a plan, they have a business model that is built around doing just that, not only acquiring, but also growing organically. And I think when you see that from a lending perspective, it looks very obvious to you from my chair, at least.
Yeah.
So you can see it. You can see it in their performance. You can see it in the way they operate. You can understand that in conversation. You can see it in reports. So I think when you do that and you're deliberate about it and you see it, you start to see that their performance is top tier. Yeah. They're performing within the broker dealer top tier, and they're getting noticed in the state as a top performer as well. So when you have all those things, you understand that you've got someone that you're going to be able to grow with, and you want to partner with those folks. You want to help them be successful. And I think that's what I feel like my role is to help them gain success.
That's fantastic. We're getting ready to close things out here, but one of the things I want to spend a little time on is the timing of all these types of things. You brought it up, and during our prep call, I really hadn't thought about this, but you talk about how, like, you're just coming off the busiest time of the year for your firm. And I thought to myself, like, what does time have to do with it? It's like, if I'm going to buy a business, if I start in May and decide, okay, we're going to acquire a business and let's start exploring financing options and so forth, I do that in May. But you mentioned that's not always the case. Actually, there are certain times a year where it's much, much busier for M&A activity. So let's spend a little bit of time on that to beat the time thing into the ground.
Yeah. Well, I think everyone believes that it's easier and better to start off the acquisition of a business either from the seller standpoint or the buyer standpoint at the end of the year. Mm-hmm. So if everyone in the industry is buying and selling at the end of the year, it makes the end of the year very busy. So the last quarter of the year, with holidays, with the rush of people trying to get to year end, with the normal obligations that a bank has to close out year end, it gets very busy. It gets convoluted. So we have to really start people a little bit early when we get towards the end of the year. So time service right now is going to be much quicker if you're asking about from start to finish, when I can get a deal done in 4 to 5 weeks. When we get closer to the end of the year, that's going to become 6 weeks. So, and we have to prepare people for that. So if you're going to do financing in, at year end, I would want to start in September, definitely documenting my file, having everything done, being prepared to get into underwriting so that you have the ability to efficiently get through, not struggle, not have any concerns with whether or not you're going to get financing done. And there can always be delayed disbursement. So I can get you approved and closed. And if we had to disperse part of the proceeds in this year and part of the proceeds in next year, there's a bunch of structured things that can be done to make sure that there's a comfortable acquisition and disbursement process associated with your finance.
That's really smart. And it's funny that these are the types of things that I don't think people think of right off the top of their head. They're thinking, I'm going to sell this thing or buy this thing and it's going to happen here, right? Obviously there's an escrow process, making sure the clients stay and all that type of stuff. But to your point, you can adjust the timing. This is part of the terms of deals, right? But the best thing to do is make sure you start early, right? Earlier than you think you need to, right? To get the process rolling, making sure you secure your funding, talk to you. Much rather find out, like, hey, this is how much you're going to be able to borrow before I throw that gauntlet down on the table. And also, this is how long it's going to take before we say, oh yeah, we're going to be closed by June. Well, that might not be possible. Why don't you go find out?
Right.
Yeah.
Right. I mean, there's a process there. So, I mean, and there's a fair amount of the process of document collection. Yeah. So unfortunately, you need to be prepared for that piece.
Yeah. Before I let you go, are there any other tips that, I guess, maybe things that advisors are often surprised by that you ask them about when this process is ongoing, or the things that they're like routinely have to tell them, hey, we need to do this, or we need to talk to this person. And they're like, oh yeah.
Yeah, I think one piece is all of the key people within the firm are required to carry life insurance.
Okay.
And life insurance, especially during the pandemic, was very difficult to get timely. So if you don't have life insurance within your partner group or individually that covers the loan amount, you should start gaining that. Some term insurance that will extend past the term, that will meet the loan amount, and that can be assigned to your lender is going to be a closing piece that you have to accomplish. So I think that's always a piece that we run into, getting a document checklist from your lender up front so that you understand what the obligation is from a document standpoint. That's going to be the biggest time saver for you in the process. And then what we talked about before, having financial statements done at year end and year to date. Those pieces are extremely critical in spreading financials and understanding how you're performing.
That's fantastic. That's really good advice. I love the one about make sure you get the insurance thing done. And so these things just take a little bit of time, right? And it absolutely makes sense. Like, since we're lending on revenue here, we're not lending on factories and machinery and patents and so forth. You know, if you pass away, that puts a big time risk on the revenue, and that puts a loan at risk. So having that life insurance in place is really, really a smart idea.
Yeah, and you don't want that if there's a life event. You don't want that burden on your family. You want you want something out there that takes care of that and let everyone come together and deal with it appropriately. So it's not only prudent from a financial standpoint. I think it helps your family.
Absolutely. Well, Jeff Conyer, I think a lot of people are going to want to follow up with you, learn a little bit more. Our audience just happens to be mostly financial advisors and executives at wealth management firms. So lucky you're in the right room.
That's awesome.
What's the best way for people to follow up with you? Because I'm sure they are going to have questions and want to follow up a little bit more.
Yeah, I can be reached by email at jeff@wafnow.com and website www.wafnow.com. Phone number 317-514-7576.
Fantastic, sir. Well, we'll make sure that we get that all linked up in the show notes for this episode of the podcast. And we'll be sending some people your way. Thank you very much for joining me on the show. It's great having you.
It is my pleasure. Thank you.
Thank you, sir. Thank you very much for listening to and or watching this episode of the Modern Financial Advisor podcast. It's always fantastic to have you with us. Huge props to my man, Jeff Conyer. Welcome aboard the Trulytics Solution Partner community, I guess is what you want to call it here. Fantastic to have you and the Wealth Advisor financing team with us. This is going to be amazing stuff. And little did you know, when you signed up to be a part of this community, you're going to get the whole InvestNet community along with it. So awesome. This has been a fantastic episode. Hope you enjoyed the show. We will talk to you next time on the Modern Financial Advisor podcast. See ya. Bye.